Okay, students, how are you? We are going to start the practice, the study hub practice, MCQs practice from study for pricing. First MCQ is a shopkeeper finds that it if he sets the price of particular product at $9 per unit, he sells on average 150 units. He sells on average 150 units of the product per month. Okay, actually he's saying that if he sets the price, if he sets the price at 9, he will able to sell 150 units. Here focus that. However, at the price of 10, he will sell 110 units. Means when he is increasing the price from 9 to 10, when he is increasing the price from 9 to 10, the difference between the demand will be at 9 he is able to sell 150 units. Now he is able to sell 110 units. Obviously, increasing the price will decrease the demand, will decrease the quantity. Now we have to calculate price elasticity of demand. So price elasticity of demand, the formula for price elasticity of demand is percentage change in price. Wait a minute. Percentage change in quantity. Sorry. Percentage change in quantity divided by percentage change in price. So we'll see that how much percent of quantity will be changed according to percentage change in price. So first I'm going to calculate percentage change in price. This is the old data. This one is old data for price and demand. This is the new data. Considering that, first I'm calculating percentage change in price. So percentage change in price goes from 9 to 10. So the percentage we can calculate by the formula I'm writing here. If you have to calculate anything in percentage, the change in percentage, you have to do new amount minus old amount divided by old amount into 100. So new amount was 10 minus 9 divided by 9 into 100. Let us let us calculate that. It will be 1 divided by 9 into 100. It means that percentage change is 11.11%. 11.11%. This is a percentage change in price. So percentage change in price, I'm writing here 11.11%. Now for the quantity, if you see quantity is going to from 150 to 110. So new value is this one. Again, percentage change in quantity. Percentage change in quantity will be 110 minus 150 divided by 150 into 100. So it will be, so it is 26.67. 26.67. It will be 26.67. So what you will do here, you have to do the first calculate percentage change in price and percentage change in quantity. Now just divide it. 26.67 divided by 11.11. It is 11.11. It is 2.4. It is 2.40. The answer is 2.40. So we'll say that price elasticity will be 2.40. Answer will be B. Answer will be B, 2.40. It's the price elasticity of demand. In the numerator, you have to write percentage change in quantity. I have told you how to calculate. And in denominator, percentage change in price, again, we have discussed that. So answer is 2.4. It means the product price elasticity is so much that changing a little price will increase the will change the demand so much. It means that if the answer is so much higher than like 1, it means that the changing the price a little bit will change the demand so much. It means that. So it's 2.4. Okay, let us confirm. B will be the answer. Okay, the correct answer is B. Okay, the correct answer is B. Now, next question. Let us discuss that as well. Next question says that P company produces a budgeted sales volume for next 3 periods is 50,000 units. Production capacity is 18,000 units per month. Following information is available: selling price, variable cost, and fixed overhead profit is also given. The potential overseas customer has requested a price of initial order of 3,000 unit over the next 3 months. Potential customer, there is some customer who wants to purchase something, has requested a price for an initial order of 300,000 over the next 3 months. Basically, they have requested that they want to take 3,000 units for first 3 months. Next 3 months, So he's asking for the price. Assuming P company wishes to ensure the short-term profit is not reduced if the inquiry becomes an order, what is the minimum price of the unit that should be quoted? What would be the minimum price? He is asking about the minimum price that we must be obviously offering to him. So it's a concept of one-off contract in which we have one customer and he is saying that what in case we have to offer someone a minimum price. So we have discussed in one-off contract that minimum price for any order will be the relevant cost of that product. In the topic we have discussed that the relevant cost will be the minimum price. So if you see in all the scenario, only one relevant cost is there, that is variable cost 80. Other is fixed overhead like 33 are fixed overheads. So fixed overhead is already irrelevant, we know. So irrelevant cost will not be there. At least we will charge him the relevant cost and only variable cost is here. So answer will be A. 80. Wait. Yes, answer will be A. So it's written minimum price is relevant cost. Capacity is 54,000 per quarter. That all that is written, no issue for that. The complete scenario is given, no issue. Just we know that actually 4,000 is sorry, actually 80 is the variable cost. Actually 80 is a variable cost. So if we want to give him 3,000 units, we can give him at the rate of $80 because it's the relevant cost. It's the relevant cost. Let us. After that, a cost per unit of the product manufactured by a company is complete. It's given. Okay, a company uses marginal cost per plus pricing. If A seeks 40% margin on sales, what is the selling price of the product? 40% margin on sales. Okay, what is the selling price? Okay, so the company is using marginal cost plus pricing. First of all, marginal cost means only variable cost. Like here, it's given that material, that labor, that overhead. Share of fixed cost is not obviously the marginal cost. So these three are the marginal cost. 12 plus 17 plus 7. 12 plus 17 plus 7 will be 12 plus 17 plus 7 will be 36. Will be 36. It will be 36. Now it will be 36. Now what we have to do? This 36 we have got the marginal cost. And what is our scenario? We do marginal cost plus pricing means we have to add the profit of 40% to reach the selling price. To reach the selling price, we have to use marginal cost plus 40% margin. 40% margin. Now, margin, in the margin, we know selling price is 100%. Margin means selling price is 100%. And if in selling price, profit margin, selling price is 100%, profit is 40%. So it means it is 60%. The cost is 60%. The cost is 60%. Why cost is 60%? Because it's not 40% markup. In the markup case, cost is 100% plus profit 40, selling price will be 140%. But in margin, selling price is 100, profit is if profit is 40, marginal cost will be 60%. So this 36 represent the 36%. Now we have to tell the selling price. So easily what we can do, 36, what we have to do, take the value of marginal cost, $36, divide it by its own percentage. What is its own percentage? 60%. Obviously marginal cost percentage is 60%. So 36 divided by 60. No need to write the percentage sign. Multiply where we want to go to the selling price. What is selling price percentage? That's 100. Multiply with 100. So 36 divided by 60 into 100, it will be 60. So final selling price will be $60. So what we have to do, we have to take all the marginal cost, mean variable cost, and we know its profit margin. So cost will be 60%. Considering that 36 total marginal cost as 60%, we come to know the value of selling price by taking that value to 100%. That is $60. So answer will be B. Okay, it will be B. Let us see. Let us confirm that. Okay. So the answer is B. Correct. After that, there are some like theoretical MCQs. Identify by selecting the relevant boxes in the table below whether the following statements about sales pricing policies are true or false. Okay. Market skimming will lead to constant price throughout product life. No, no, false. Why false? Why false? Because why false? Actually, A B means I think so. A B means true false. Okay. So first is false. Why? Because market skimming, in the market skimming you set the price higher at the start. After that you go downward. So it's not constant. Cost plus pricing will lead to be profit being maximized. Profit being maximized. Yes, we can say that low cost plus pricing will lead to the profit. We can say that cost plus pricing will lead to guaranteed profit because you will having the profit obviously. But if you say that it's like maximizing that, I think it will be, I think it will be false. I think it will be false. Okay, let's go on the next MCQ. If price elasticity of demand is greater than 1, increasing the price will reduce the revenue. Yes, true. Why? Because price elasticity is greater than 1 in which scenario? In the scenario where a little change in price will decrease the quantity so much. If you are like taking the price from 9 to 10, just 10%, just 10-11%, your quantity will obviously decrease not by 10%, by more than 10%. Obviously, then the answer will be 1. Obviously, we have done like the question in which we have calculated 2.4 price elasticity of demand, where we have seen that the price is going from 10 to 9, 9 to 10, 9 to 10, just, and your demand falls from 150 to 110, and answer was more than 1. So in the scenario, if price elasticity is more than 1, it means you have to set the lower price to sell the product. Okay, now lower price to sell the product. If you are like increasing the price, they're saying you that increasing the price. So if you're increasing the price, your revenue will be reduced because your quantity will fall by more percentage as compared to the increase in price percentage. So it is true. Penetration pricing is appropriate when launching the new product in the competitive market. Yes, you can say it's true, competitive market. So let us confirm. Oh, okay. So yes, we are right. We are right. First two are false, second two are last two are true. Now we were discussing this second point. I've just mentioned it true then false. Why? If they say that cost plus pricing will lead to guaranteed profit, yes, we know, because in the cost plus pricing we write the complete cost plus we add the profit and then selling price. We know that profit will be earned because we know already we have done the mentioned the cost and then adding the profit in that, we know profit will be there. But is it maximizing your profit? No, it is giving you a profit, but maximization is not the point here. Profit maximization can be done in other ways, not through cost plus pricing. So that's the reason. See, it's written cost plus pricing ignores the market, so it is not likely to maximize the profit because they're not seeing the market. So maybe your cost plus pricing says sell at $100. According to cost plus pricing, you come to know that cost plus pricing is saying that sell your product at $100. We are selling at 100 and our competitor is selling at 80. No customer will take from us. So it's not it's this concept is not maximizing our profit. Okay, next. If 6% fall in price causes the increase in demand by 9%, what is price elasticity? Obviously, if the demand is increasing more and price is falling less, it means on the other side, it means that percentage change in quantity is upward more and percentage change in price is less. So obviously answer will be more than 1. It will be 1.5. So answer will be more than 1. So it will be answer will be A. Answer will be A. Okay. Now going towards the next question. The company sells its product for $20 per unit. $20 per unit. in order to achieve the objective of maximizing profit. Okay, selling price and quantity is the relation they have given you, that P is equal to 30 minus 0.0002 Q. Assuming that there is no opening and closing inventory, what is the marginal cost at optimum level of output? What is the marginal cost? Very easy question. Very easy question. Very easy question. We have to calculate the marginal cost. We have to calculate the marginal cost. You know, you know that you have got the relationship between price and quantity, 30 minus 0.0002 Q. And you know that if you have studied the pricing concept, obviously marginal revenue formula will be 30 minus 0.0004 Q. Why 4Q? Because it is multiplied, this value is multiplied by 2 in marginal revenue, Now you have set the price of 20. Obviously you are selling at the 20 price, selling at 20 price. So setting the 20 price, how much quantity you will sell? First we will calculate this quantity. First we will because they have already calculated your optimum price already, because they know that if it sells at 20, it will achieve the objective of maximizing profit, which means the price is set, price is okay. According to that price, we will calculate the quantity first, that what was the quantity there. So 0.0002 into quantity we have to calculate. So it will be like 0.002 on the other side, 0002, 0002 is equal to 30 minus 20. We have taken this 20 to other side and that 0.002 on the left side. Now it will be, quantity will be 10, because 30 minus 20 is 10, 10 divided by 0.0002. So 10 divided by 0.0002, it will be 50,000. Obviously, the data we have given with this equation and this price, we have calculated the quantity, and it's very easy. It's very simple. 50,000 is the quantity, optimum quantity that you have to sell. Till now, you have confirmed about that. Now you have to calculate marginal cost. Okay, wait. Now you know that marginal quantity, the optimum quantity is 50,000. Use this optimum quantity here. So 30 minus 0.0004, quantity is 50,000. So marginal revenue answer will be, 50,000 into 0.0004, 20, and marginal revenue will be 10. Marginal revenue will be 10. I have calculated complete. Marginal revenue is coming 10. Now you know the one concept. Now you know one concept. You are using the price that is optimum, right? And you are using the quantity that is optimum, best quantity. And that price, that best price, you will get if you have the rule behind that. Which rule? We have studied in the lecture. Which rule? At the point where marginal revenue is equal to marginal cost, at that point you can calculate the price. So they have given you the reverse calculation. Basically they have already given you price, optimum price. So obviously this optimum price would have been calculated if you have considered marginal revenue as marginal cost. So this marginal revenue is equal to marginal cost, that is also 10. Only on this point, when marginal revenue and marginal cost are equal, only on this point where marginal revenue and marginal cost is equal, you can calculate the optimum price. But here they have given you optimum price already. So it means that this marginal revenue must have been equal to marginal cost. So answer will be 10. Simple. Answer will be 10. So answer is B. Let us see. Let us see this. Confirm, go back again, confirm. Yes, answer is B. Answer is B. So you have to clear the concept completely before doing the MCQs, right? After that, okay, this is, I think so, tabular approach. Here you are given with total cost, you are given with total cost, you are given with total cost and selling price. And here you are given with units, you are given with the units. Okay, at what level the demand will be maximized? Okay, that's very easy. That's very easy. What you have to do, you know that the prices and the cost and prices you are given with is, cost and prices you are given with is according to the units 1000, 2000, 3000, 4000, and all in the sequence, right? So considering if all these units are like same, now what we are going to do, we are going to calculate the marginal cost and marginal revenue here. Because it's like 1000 2000 in the flow, like 1 2 3 4 5 6, same 1000 2000 flow is same. That flow is same means it's getting increased as per 1 2 3, like 1 2 3 and 1000 2000 3000, that's same. So we can calculate marginal cost and marginal revenue here. If we calculate marginal cost and marginal revenue here, let us calculate marginal cost here. It will be, marginal cost is additional cost on other unit. So 500 here, marginal cost is 50. Here marginal cost is 75. How I am calculating it? I'm taking the difference between last cost, like 500. First is 500, but second is 500 minus 550. 550 minus 550. Then 625 minus 550, this 75. Then 725 minus 625, it's 100. Then 850 minus this is 125. Then 1000, this is 150. This is the marginal cost. This is the marginal cost. This is the marginal cost we have calculated for all of the total cost, all of the activities we are given with. Now calculate marginal revenue. First one is 350. Second is like three like it's decreasing by selling price per, okay, it's selling price per unit. Let us calculate the, wait. It's per unit given and it's total given. Mm, what we can do with what we can do here is best. Wait, let me calculate it by calculating cost per unit here first, then calculate marginal cost. Let us calculate cost per unit here. First calculate, why cost per unit? Because selling price is given per unit. So let us calculate cost per unit, then we'll calculate marginal cost, so that we are given with the like the units, the units we are given with, like we can do selling price in total as well. Selling price in total as well, we can do that as well. But for that, the best thing is, wait a minute. Okay, so actually this question can be done. This question can be done through the marginal cost concept, but the main issue here that I'm seeing is that marginal cost is the increase in cost when there is increase in one unit, like going from one to two. One unit, from one unit to two unit. When you are going from one unit to two, then two to four, then four to six. Obviously, in that scenario, like you are increasing the units, but that's like one. After that, increasing units by one, the change in cost will be the marginal cost. So marginal cost is the difference difference between one and two, like two units. Like for example, if it's given one, wait a minute, one unit, two unit, three unit. So if cost is 100, 180, 250. So we'll say that marginal cost here will be 180 minus 100 is 80. 250 minus 180, it will be 70. This is the marginal cost. But here the units are given in total. So at what they're asking, at which demand the profit will be maximized. There is one easy way as well. There is one easy way. Let us calculate through that. Let us do through that. It must not be done like this. There is very easy way. You have to calculate the total profit at each level, right? You are given with total cost. This is selling price. Just calculate the total sales. Just calculate total sales at each level. Like 1000 into 350, sales will be 350,000. 300 into 2000, sales will be 600,000. Wait a minute. 1000 into 350 into 1000. Okay. Now 2000 into 300, it's 600,000, not 60,000, 600,000. After that, 250 into 3000, it the sale will be 750,000 here. Now 4,000 into 2000, it will be 800,000. 150 into 5,000, it will be 750,000 of revenue here. I'm just calculating with the unit. It will be 600,000. Now we have calculated the total sales using the selling price and units, and we are having the cost. We have to tell that at which level of demand profit will be maximized. Just calculate the profit. We know that how profit is calculated. How profit is calculated. Just deduct the cost from the sales. Just deduct the cost from the sales. Simple. Very easy. Very easy. If you see the sales are like here. If you see the sales are 350,000 and total cost is 500. So profit will be, there will be the loss of 150,000 here, because 350 is the sales revenue and 500 is the cost. Here 600 minus 600,000 minus 550,000, 50,000 will be the profit here in the second scenario. Here 750,000 minus 625, 750 minus 625, it will be 127, 650 minus 625, it will be 125,000 profit in third scenario. In the fourth scenario, 800,000 minus 725, it will be 75,000 profit. Now 750,000 minus 850, it will be 100,000 loss, and 600,000 minus this 400,000 loss. So at every level we are given with, at every from 1,000 demand to 6,000 demand, considering this range, we have calculated the profit at every level. Just deduct the loss, just deduct the cost from the selling sales. So first we have calculated the sales, then we have deducted the cost. We come to know the best profit we are earning is 125,000 when it was at the third level, and third level is 3,000. It means at the level of demand, which level of demand? At 3,000 you are earning the maximum profit, because he asked you the what is the level of demand at which profit will be maximized. So it's 3,000 at which profit is being maximized. So answer will be B. Answer will be B. So let us see that. Mm, yes, correct answer is B. Correct answer is B. Just calculate non. See, they have calculated in the solution. They have done in the solution. Very easy, very easily. Just all the production level they have taken. After that, calculated the revenue just by multiplying selling price with the units. Take the cost and just calculated the profit. And at this point, they come to know that there is a maximum profit. So you have to understand this concept. After that, another question for pricing. Let us start this. Okay. A bill company currently sells its major product line for 25, at which demand is 4,000. Okay. Market research has suggested that a cut in the price of one would increase the sales by 800. Okay, the market research says that if they decrease the price, they take the price from 25 to 24, the demand will go to 4,800, because demand will increase by 800, right? So if the P denotes the selling price, Q denotes the demand, what is that demand curve equation? Actually, we have to tell this equation. Okay, very easy, very easy. We know that price equation is A minus BQ. A minus BQ. First we calculate B. B, the formula for B is change in price divided by change in quantity. So change in price is only 1 and change in quantity is 800. It's written that increasing the price by decreasing the price with 1 will increase your profit, the quantity will increase your quantity by 800. So let us calculate 1 divided by 800. It will be 0.00125. From here we can easily calculate. A is the answer. Simple. They have calculated P is equal to 30 minus 0.00125 Q. We haven't even calculated A value. Why we haven't calculated A value? Because we don't need to calculate. We are just confirmed from the value of B that answer will be A. Just the value of B is 0.00125. So here we are confirmed that P value will be A minus B, B, not B, 0.00125 Q. 0.00125 Q. You can also calculate the value of A. If you want to calculate, let me calculate that as well. No issue. But the answer is A. Confirm. Confirm. Let me calculate that as well. If you have to calculate A here, maybe sometimes in the two options B value is same. So what you will like take then? So A, how to calculate? Now you have one thing Q and one thing P, one quantity and one price. Now you know that the price given is 25, at which quantity is 4,000. According to the question, just take the values. According to question, just take the values. Take value 25 at the price of 25. The demand was 4,000. Take 25 here is equal to A minus 0.00125, and where Q will be 4,000. So just calculated 4,000 into 0.00125. It's 5. A minus 5 is equal to 25. So A will be 25. Here 5 is deducting. On the other side, it will be added. So A will be 30. A will be 30. So okay, okay. A is the answer. A is the answer. Simple, simple. Okay, let's go to the next question. Let's go to the next question, guys. A company has entered two different markets. Okay. Uh, in market A, it is initially charging low prices. It is initially charging low prices so as to gain a rapid market share while demand is relatively elastic. In market A, basically product is entered with charging low price so that they can gain the market share. Means they want to increase their customers. In market B, it is initially charging high prices as to earn the maximum profit while demand is relatively inelastic. So at the start they have charged high prices. So we have to tell that what is the answer. Obviously A is the answer, because in penetration pricing in market A, obviously we are charging low prices, means penetrating pricing, and skimming, by price skimming, means like when you are charging initially high. So answer will be A here as well. A here as well. Next question. Okay, a manufacturing company prices its products to the given markup of 100% on variable cost. Okay, if selling price increased by 50, if selling price increased by 50%, quantity sold is expected to reduce by 40%, but the variable cost is expected to remain unchanged. Okay, selling price increase and quantity decrease. Okay, what will be the effect on revenue and total contribution of the change in pricing policy? Of the change in pricing policy. So let's see. Let's see. Okay, so what we have to do? See, if selling price is being increased by 50%, demand will decrease by 40%. Let us consider here, because values are not given, we'll consider ourselves. For example, you are selling something at $100 and your demand is 100 units. This is the current scenario. After that, what happened? When you increase the selling price by 50%, means you have taken this 100 to 150. 50% increase means from 100 to 150, it's 50% increase. So when you are taking the price from 100 to 150, means increasing 50%, your demand is decreasing. Your demand is decreasing by 60. Your demand is decreasing by 40%, means it will come to 60 units. So now they are asking you that what will be the effect on revenue and contribution. Revenue and contribution. Let us calculate that. Let us calculate that. So calculating the revenue will first calculate through this process. When old case, when 100 was units, 100 units into 100 selling price, revenue will be 10,000. Revenue will be 10,000, right? Means variable cost will be, assuming, just I am assuming that 100 what the unit, and variable cost per unit, we are assuming that it's like 30. Just assuming that variable cost is 30, so it will be 3,000 and contribution will be 7,000. In this scenario, when we have considered 100 selling price, 100 units, and variable cost is 30, contribution is 7,000. Now let's calculate with a new concept where we have applied these rules, that increasing 50% selling price and decreasing the demand by 60%. So revenue in this scenario will be now revenue is 150 but demand will be 60, so it will be 9,000 less cost. If you see the cost, now obviously you are selling 60 units, so you will take 60 units into variable cost. You know that variable cost depends on units, so if units come from 100 to 60, now variable cost will be calculated according to 60 units. But they have told you that variable cost per unit will be unchanged, means 30 will be same. 30 will be same. The 30 we are using here, it will be same here, only number of units will change. So it will be 1800. Now calculated, it will be 7,200. So if you see, when we have increased the selling price, reduce the demand, but not changing variable cost per unit, it's unchanged. In this scenario, we come to know that our revenue is decreasing, see, from 10,000 to 9,000, but our contribution is increasing. So answer will be B, that revenue will be decreased, contribution is increased. So we have taken the scenarios ourselves. First take 100 and 100 selling price and 100 units accordingly, and then just apply the rule. You can take other values as well. Okay, last question of study hub of pricing. product C currently sells 8,000 units per year. Product C currently sells 8,000 years per year at the price of 50. Market research shown that increase in price of 2 would decrease annual sales by 800. What is the marginal revenue? What is the marginal revenue? Marginal revenue at output level of 6,000. What is the marginal revenue at output level of 6,000? Okay. So if you see the marginal revenue formula is, we have to calculate marginal revenue. So marginal revenue formula is A minus 2B cube. So first we have to calculate A and B, so that we can calculate the marginal revenue. Q, we are having 6,000, but A and B we have to calculate. B formula is change in price divided by change in quantity. So they've written that 2 is the price, change in price, and quantity will be decreased by 800. So 2 divided by 800 will be 0.0025. So now the formula of marginal revenue will be is equal to A minus 2 into 0.0025 Q. Now we have to calculate A. Now we have to calculate A. How we'll calculate the A? We know that A can be calculated through this formula. P is equal to A minus BQ. And we know that A we have to calculate, minus B we have already calculated 0.00. Wait a minute. B we have already calculated 0.0025, and Q and P we are having. Which Q and P we are having? See, this price at 50 price we are having the quantity of 8,000. So 8,000 is the quantity when we are having the price of 50. Let us calculate A through this. 50 is equal to A minus 8,000 to 0.0028,000 will be 20. So A will be 50 plus 20, it will be 70. So we have got the value of A from this formula. Whenever we have to calculate A, so obviously always this formula will be used. P is equal to A minus 2, A minus BQ. B we have calculated. P and Q will take from the question. Price and quantity will calculate the A. Now A also we have calculated. So marginal revenue formula will be A, that is 70 now, minus 2 into 0.0025. Now he's saying that calculate marginal revenue at 6,000 units. Now you know the quantity 6,000 units, just put the quantity and calculate it. So 2 into 0.0025 multiply 6,000, 30, 70 minus 30 will be 40. So marginal revenue will be 40. Marginal revenue will be 40. So answer would, let us write this answer here. Who have written here 88? It's 40. It's 40. Confirm. Yes, it's correct. So here we are done with the practice of pricing. Here we are already done with the practice of pricing. Complete practice pricing we have done. So if you see the, wait a minute, let's see. We have done all these questions. Now you need to, obviously, whenever I do the practice, it doesn't mean that you have done the practice. That practice I have performed for you. Now you have to perform more practice from other sources like Kaplan, like BPP. And if you feel any issue, you can contact us. Till there, we are ending the lecture. Meet you guys in the next lecture. Till then, take care. Bye.